take a look at stochastics. This is a statistical process with wider applications, but was adapted and developed for technical analysis by a gentleman called George Lane in the late 1950s. The stochastic oscillator we use is a leading momentum indicator. Simply put, stochastics show the location of the current closing price relative to the high-low range over a set number of periods.
Okay, and how is it useful to us as traders?
Well, it's calculated in such a way that allows it to oscillate between 0 and 100 and give the trader information about the momentum of the price move. Traders use it to identify overbought and oversold situations.
Ah, okay, I see. Can you show me some detail?
Okay, let's look at how we calculate stochastics. This is a relatively easy one.
We'll see.
There are two lines plotted on a stochastics indicator. The first is referred to as percentage K.
What does percentage K mean?
It's the name of the main line that we see plotted on a chart.
Oh, okay.
So the formula for this line is on screen.
Looks complicated.
It isn't really. Once you know what it means, you set the periods that you want the indicator to look back over. The normal setting here is 14 periods. The formula looks at the highest high and the lowest low for the whole period you are looking back over. It then looks at the most recent close and works out where it sits as a percentage against the range.
I'm with you so far.
If the current close is at the low, the percentage K will be 0%. If it is at the high, then it will be at 100%. If it is halfway in between, it's 50%. The number gives us some good insights into the momentum of the price. The second line is called percentage D, and it is a 3-period simple moving average of percentage K. This has the effect of smoothing, but also lagging percentage K.
Okay, I understand what an SMA is, but it's not of the price, it's of the percentage K line itself. Is that right?
Yes, you are right. Let's take you through a quick example, which you can also download from your materials section. This is the data for DAX for the 14 days. The highest high is here. The lowest low is here, and the current close is here. Put this into the formula and we get a percentage K of about 51. This makes sense. This closing price is about halfway between the highest high and lowest low.
Okay, what does it look like on a chart?
Okay, let's look at how we add stochastics to a chart. As with the other indicators, this is fairly easy. Let's add a stochastics to a chart for the DAX, or as it's known in spread betting, the Germany 30 market. So if we choose studies from the drop-down, it will add the indicator below the chart. The indicator's periods correspond to the periods on the chart.
Yes, I see that.
Good, so let's open it up a bit while we explain it. Okay, we can see it here that the settings are for 14 periods, which is fine for this example. The white line is the percentage K and it's lagged by percentage D, the 3-day moving average.
I'm with you so far.
You can see here over on the right, it ranges between 0 and 100. At the moment, percentage K is above 90%, which means the price is about 90% of its trading range for the last 14 days. If we visually inspect the chart, that looks right. The price has traded up recently.
Ah yes, I'm following.
In fact, Stochastics has recorded the price as being above 90% for the last month. For this to happen, the price needs to have traded up. We can also see here that the percentage K line has on a few occasions dropped to around 10%. We can see that this has corresponded to a pullback.
Yes, I see that.
To help with their analysis, some traders like to clearly define boundaries on the indicator.
How would we do that then?
Well, for example, a trader might want to define boundaries as 80 and 20. You can do this by going to the indicator settings, here selecting show zones and setting the upper and lower boundaries. So we haven't seen a momentum indicator before, as they aren't used to directly confirm trends or volatility.
I thought momentum and volatility are the same thing.
No, they are different. Volatility describes how much a price fluctuated around an average. It doesn't concern itself with the direction, just that it moved. We saw this in Bollinger Bands with the widening bands. Momentum is all about the strength of price movement in a given direction, up or down.
I think I follow.
It's normally better to visualize these things. This is a fairly frantic up and down ranging market. It's in a sideways trend. This would have high volatility but low momentum. It's up and down a lot but going nowhere. This second trend, on the other hand, has good momentum but low volatility. It's not jogging around a lot, but it's going somewhere. When trading on leverage especially, traders like strong bullish or bearish trends with low volatility.
Yes, I get it now. So stochastics is telling us about the strength of momentum.
Yes, traders use that information in a number of ways. By knowing the strength or weakness in a price, traders assess whether a security might be overbought or oversold. Some take the view that strength can't last forever and consider overbought as an opportunity to go short and oversold as an opportunity to buy.
Okay, so how would we assess whether a security is overbought or oversold then? What would we need to do?
Well, this can be done objectively with the 80-20 boundaries we discussed at the end of the last video. When the percentage K, or if you want to be more certain, the percentage D is above 80%, it can be considered overbought.
That makes sense. And so I'm guessing if the percentage D is below 20%, it's oversold.
That's right.
And it's as easy as that?
I'm afraid not. If it was, everyone would be doing it. There is a few more factors to consider. Let's look at our DAX chart again. So, it's important to note that overbought readings are not necessarily bearish.
Wait, how so? I would have thought that an overbought reading would always be bearish.
Well, securities can become overbought and remain overbought during a strong uptrend. Closing levels that are consistently near the top of the range indicate sustained buying pressure. Remember, our indicator is only looking back 14 days. Good trends can go on for a lot longer.
Right, so an overbought security can be bullish too.
If we look back at the last month, we can see the stochastics indicator has consistently been above 80. As a trader, I would have lost money shorting here when percentage K or percentage D first became overbought.
So I take it that an oversold reading isn't necessarily a signal to buy either.
That's right. In a similar vein, securities can also become oversold and remain oversold for a long time during a strong downtrend. Closing levels consistently near the bottom of the stochastics range indicate sustained selling pressure.
I see. I'll have to remember this.
To accommodate this, some traders look at when the percentage D line crosses the percentage K, when above the 80 or below the 20, in order to spot when momentum has shifted. It's like the moving average crossover strategy we looked at a few lessons ago. The theory is momentum itself moves in trends, and the turning points can be spotted using this technique.
Does this produce better signals?
The issue is still that trends can go on for a long time, even with crossovers. If the trend continues, you will see lots of false signals. If we look here, we can see that happening. Given the limitations of just looking at overbought, oversold crossovers, traders look for divergence between the percentage K line and the price of the underlying market as a way to assess whether the momentum in a trend is waning.
So when would a divergence occur then?
Well, a bearish divergence starts when the percentage K line is over 80 and forms declining highs, while prices continue to make highs.
Can we see what divergence would look like on a chart?
Of course, let's go back to our DAX chart. So there is a divergence between the price, which has formed a new high here, and the momentum, which hasn't formed a new high. This shows momentum is slowing, but the price is still going up, suggesting the bulls pushing the trend might be losing steam.
Okay, so would this movement indicate an overbought or an oversold situation?
Good question. This is probably a more valid signal that a trend might end than the simple overbought and oversold interpretation.
Can you also get bullish divergence?
You sure can. Look, this has happened here. Percentage K makes higher lows and the price lower lows. The bears appear to have run out of steam. Divergence is a particular favorite of mine. However, seeing a divergence isn't necessarily a trade signal, and it should be combined with other layers of evidence, such as support or resistance, line break, and a reversal candlestick pattern. Just as every indicator has its benefits, it also has its drawbacks. Generally speaking, there aren't too many complaints from the trading community when it comes to stochastics. When there is, it's normally because of three issues. First, because stochastics look at just three numbers, it means we are placing a reliance on only a handful of numbers.
Okay, I see. As long as the numbers are correct, that doesn't seem too much of an issue.
Second, because two of these numbers are the high and the low prices, it means it is looking at the extremes of the trading range. This is fine, but there is no consideration given to the numbers in between. These can be important.
And the third one?
The indicator's inability to recognize a trend, as we've seen in our example, is sometimes criticized. The indicator can remain in an extreme for long periods of time when a sustained trend is playing out, just like we saw with our DAX example.
So, because the indicator can stay in extremes for so long, it can sometimes give false signals. We start to discount the usefulness of the indicator and miss a genuine signal that a trend is changing.
Yes, personally, I always think this is a little harsh. Like all indicators, stochastics is designed to do a specific job. It's designed to tell analysts about momentum.
Of course, every indicator is designed for a specific purpose, so we can't expect each one to do everything.
Exactly. As you should appreciate by now, you can't reasonably expect to trade the markets using just one indicator or technique. You need to use a wider set of measurements.
The stochastics indicator was developed by George Lane in the 1950s. It shows the location of the current closing price relative to the high-low range looking back over a set number of periods. It's calculated in such a way that allows it to oscillate between 0 and 100. This gives the trader information about the momentum of the price move.
There are two lines plotted on a stochastics indicator. The first is the percentage K line. The second line is called percentage D and is a 3-period simple moving average of percentage K. When it comes to plotting a stochastic on a chart, some traders like to clearly define overbought and oversold boundaries. These are typically placed at 80% and 20%.
Don't confuse volatility and momentum. Volatility is how quickly a price moves around an average. Momentum is concerned with the strength of the movement in a particular direction. Stochastics measures momentum.
Stochastics is used by traders to assess whether a security might be overbought, presenting an opportunity to go short, and oversold, presenting an opportunity to go long. When the percentage K, or the percentage D, if the trader is being slightly more conservative, is above 80%, the security can be considered overbought, and if below 20%, it's oversold.
Traders also look at when the percentage D line crosses the percentage K within an extreme. By analysing this, a trader is looking for a sign momentum has changed course.
A bearish divergence occurs when the percentage K line forms lower highs while prices form higher highs. When this happens, it might indicate the bulls are running out of steam. A bullish divergence is the opposite.
The drawbacks of the stochastic indicator is that it looks at just 3 data points, that 2 of these are at the high-low extremes, and its inability to recognise a trend. The indicators can remain in an extreme for long periods of time, when a sustained trend is playing out.
Well done, guys. A good summary. See you all in the next lesson.